All right, welcome to Talk Tickers.
Good to be here.
We're the place you come to for the essential insights from earnings calls. Today, we're jumping straight into Berkshire Hills Bancorp.
That's right, their first quarter 2025 earnings call.
So what's the big picture? What do we need to know right off the bat?
Well, the headline really is a strong first quarter for them. Pretty solid performance overall.
Strong how? Give us some numbers.
Okay, so operating net income, that saw a nice bump, up 6% from last quarter.
Okay.
And even better year over year, up a significant 32%.
32%, wow. And earnings per share?
EPS landed at $0.60. Now that's flat compared to Q4 24, but still shows a healthy 22% increase compared to last year. Though, you got to factor in a higher share count influencing that a bit.
Right, okay. Anything else jump out from the initial results?
Yeah, definitely expense management. That continues to be a real highlight for Berkshire Hills.
They're keeping costs down.
They are. Operating expenses were down 4% just from the previous quarter.
And year over year.
Down 6% year over year. So consistent control there.
That's good discipline. What about the margin? Net interest margin?
Also positive movement. It improved to 3.24%.
Which is up
10 basis points from last quarter. And interestingly, the spot in IM for March specifically was even better at 3.31%.
Okay, so maybe some momentum there. And credit quality, any concerns?
Seems quite solid, actually. Net charge-offs were low, just 15 basis points of loans.
Very low.
Yeah. And the liquidity looks good, too. Loan-to-deposit ratio actually decreased a bit, down to 95%.
All right, so a generally positive snapshot. Let's dig a little deeper then. What really drove this performance?
Well, it kind of boils down to a few key things we touched on. That improved net interest income was a big piece.
Okay.
Plus, like we said, the lower operating expenses really helped the bottom line.
And the lending side.
And disciplined credit management. They seem to be managing their loan book quite well.
You mentioned the expenses were down quite a bit. Was that just like one specific area or more general?
It seems pretty broad-based, actually. Management mentioned reductions across different categories.
So not just a one-off thing.
Exactly. Suggests, a real focus on efficiency, which led to positive operating leverage, both quarter over quarter and year over year. That's always good to see.
Definitely. And you said asset quality was strong. How strong are we talking?
Remarkably strong. Get this. Delinquencies and non-performing loans hit their lowest level in about 20 years.
20 years.
Yes, seriously.
Yeah. Down to just 42 basis points of total loans.
That's impressive. Are they building reserves too?
They are, slightly. The reserve to loans ratio ticked up a tiny bit to 1.24%.
So a decent cushion against those non-performers.
A very strong cushion, especially given how low the non-performers actually are right now.
They've been pushing that digital deposit initiative for a while. Is it bearing fruit?
It really looks like it is. They pulled in around $75 million in new deposits just through that initiative this quarter.
75 million isn't bad. No, and what's maybe more telling is that about 1 in 5 new clients are coming through digital channels now.
1 in 5. So it's really becoming a core part of their acquisition strategy.
It absolutely aligns with that whole digital first thing they've been talking about. And they're adding more features too, like a direct deposit API.
Making it easier for, say, payroll companies to connect.
Exactly. Things like that to just make the whole digital experience smoother for customers.
Okay. And what about risk? Are they cleaning up any parts of the portfolio?
They are. They made a pretty significant move selling off the rest of their Upstart loans.
Ah, okay. Getting rid of that exposure.
Yeah, continuing to de-risk the balance sheet. The combined runoff portfolios are, much smaller than a year ago. A tiny fraction of total loans now.
So charge-offs are low now, but are they expecting that to last?
Management was pretty clear on that. While levels are low currently, they do expect things to normalize a bit.
Meaning charge-offs might tick up.
Yeah, maybe drift back towards, say, the 20 basis points range, especially with, all the economic uncertainty out there. It's a prudent expectation.
Makes sense.
Yeah.
Okay, the elephant in the room, maybe. The merger with Brookline Bancorp. What's the latest?
Things seem to be moving along pretty much as expected. They've filed the regulatory applications.
Right.
And the shareholder proxy is out. They're looking for that shareholder vote sometime in May.
Okay, so coming up soon. And regulatory green light.
The expectation is still for Q3 of this year, 2025.
And behind the scenes, integration.
Oh, yeah. That planning is well underway. Both sides are working on making the transition as smooth as possible once it closes.
And the rationale is still improved profitability down the line.
Definitely. The merger is expected to give Berkshire's profitability a significant boost, particularly looking out to 2026.
Okay. Now, given the economy, what are they actually seeing on the ground? Loan demand, for instance.
It sounds like a bit of a mixed bag from their clients.
How so?
Well, some are apparently increasing inventory, maybe anticipating future needs. Others are being more cautious, pulling back a bit.
And some are probably just focused on costs, right?
Exactly, focusing on cost reduction. So different reactions to the uncertainty.
Did that translate into their loan pipeline?
It seems so. They did note some slowing in the pipeline, could indicate potentially softening demand overall.
But they're still expecting some growth.
Yeah, despite the pipeline slowdown, they still guided towards annualized loan growth being in a similar range to what they achieved in Q1. So still growing, just maybe watching the pace.
With a big merger coming up, there's always a question about keeping key people. Are they worried about retention?
They acknowledged it, yeah. Said they're actively working on managing employee retention, especially for key producers.
Makes sense. Any specific plans?
Discussions are happening, and they mentioned that both Berkshire and Brookline are considering retention grants to keep those important folks on board through the transition.
Good proactive steps.
Yeah.
We touched on the net interest margin earlier, the NIM. Positive trend in Q1. Any outlook?
Well, the Q1 result was good, and that March spot rate being even higher certainly suggests the positive trend might have some legs, at least in the near term. It's encouraging.
Okay. Another area people watch closely is commercial real estate, CRE. How does Berkshire look there?
They painted a picture of a pretty well-diversified portfolio, spread out geographically and across different property types.
Any concentration issues?
Their concentration ratio is below 300% of base capital, which is, a regulatory benchmark people watch, so not overly concentrated.
And the quality within CRE?
They reported it as solid,
Yeah.
specifically on office, which gets a lot of attention.
Yeah, definitely.
They said their exposure to potentially higher risk segments, like, say, Boston's financial district or high rises, is limited.
Okay.
And the weighted average loan to value in their office book is relatively low, so some cushions there too.
Good context. Finally, just overall financial strength, capital levels.
Still looking quite strong. CET1 ratio is sitting at 13.3%.
Healthy.
Very healthy. And the TCE ratio, tangible common equity, is 9.9%. Tangible book value per share came in at $25.50.
Okay. So let's try and pull this all together. If you're an investor looking at this call, what are the main takeaways?
I think first you really see the strong year-over-year improvement, profitability, efficiency. The strategic stuff they've been working on seems to be paying off.
Right.
Second, that Brookline merger is obviously the big catalyst on the horizon. Lots of potential for future earnings accretion there if it goes smoothly.
So keep an eye on that May vote and Q3 approvals.
Absolutely. Third, the way they're managing risk, selling the upstart loans, focusing on digital deposits, it signals a kind of forward-thinking approach,
Managing the balance sheet and finding new ways to grow.
Exactly. But fourth, you still have that backdrop of economic uncertainty.
Right, you can't ignore that.
So while their asset quality looks great now and their expense control provides resilience, investors will need to watch how those charge-offs normalize. See if it stays around that 20 basis points they mentioned, or if the economy pushes it higher.
Okay, that makes sense. A lot to consider there.
Definitely.
All right, let's pivot to our This Is Not Financial Advices segment. Always remember, these are just ideas, purely for discussion and entertainment. Do your own homework.
Absolutely, not recommendations.
So, based on this call, hit us with an outrageous but plausible trade idea.
Okay, idea number one. Given all the positive talk about the Brookline merger and that upcoming shareholder vote in May, how about a tactical long position in Berkshire Hills in BHLB, specifically trying to capture potential positive sentiment running up to and maybe just after that vote?
Okay, betting on the merger excitement. What's the outrageous part?
The outrageous part is that mergers can hit snags. Regulatory delays, shareholder dissent, integration issues. Unexpected stuff can happen.
Right, it's not a done deal until it's done. So how do you make it plausible or hedge it?
You could hedge it. Maybe pair that long BHLB position with a short position in a broader regional banking ETF, like KRE or something similar.
Oh, so protect against sector-wide problems, or if the merger news somehow turns negative unexpectedly.
Exactly. It isolates the bet more towards the specific positive merger narrative playing out for BHLB in the near term, while acknowledging the risks. Plausible because management sounds confident, progress seems steady.
Interesting, a merger momentum play with a hedge. Got another one?
Okay, second idea, maybe a bit more speculative. It leans into that digital deposit success story.
Their digital-first strategy.
Right. They're clearly focused on it, adding APIs, growing digital clients. Post-merger, the combined larger bank might look for even more advanced digital banking solutions or fintech partnerships.
Okay, where's the trade?
So the outrageous idea is to take a small, speculative long position in a fintech company that specializes in digital banking platforms, core banking APIs, that sort of thing.
Betting on a future partnership that hasn't even been hinted at.
Exactly. That's the outrageous part. Pure speculation on who they might partner with or acquire down the road. Highly uncertain.
And the plausibility.
The plausibility comes from the clear strategic direction. They want to be digital first. Larger scale post-merger might necessitate or enable new tech investments. So the need for such a partner could plausibly arise. It's just a very indirect, speculative bet on that trend.
A much longer shot, playing the strategic theme.
Got it. Okay, well, that wraps up our deep dive into the Berkshire Hills Bancorp first quarter 2025 earnings call.
Yeah, hopefully this breakdown gives you some valuable context on their performance and where they might be heading.
And just one more time, those trade ideas. Purely brainstorming, not financial advice. Please, do your own detailed research before making any decisions.
Couldn't agree more.
So what stood out to you from this call? What are your thoughts on the merger, the digital push? We definitely encourage you to keep exploring and form your own view.
Yeah, always dig deeper.
Thanks for tuning in to Talk Tickers. We'll catch you on the next deep dive.